Hey, this is Sasha. Welcome to another episode here on Hungry for Returns, where I answer your trading and investing questions about the market. If you have a specific trading or investing question, feel free to reach out by voice. So that way we could go ahead and answer your trading or investing question. Now, today's question is really all about flexible option trading strategies. So stay tuned. All right, so I had a question come in by email regarding the most flexible, the most powerful option trading strategy that there is. So, hey, Sasha, what would you do, or what is your favorite or most flexible or most powerful option trading strategy? So I'm going to answer this question for you. It's not too tough to answer it. So we're just going to dive deep on screen and get right to it. So here, if I take a look here at my option trading profile here, there's a lot of trading strategies out there. So if I go ahead, right click buy, you can see just right here, the huge list. You could buy a single, a vertical, back ratio, calendar, diagonal, straddle, strangle, covered stock, synthetic, butterfly, condor, iron condor, vertical, double diagonal, unbalanced, and deep and wide. So there's so many strategies out there when it comes to trading options that really, which one do you pick? And they all ultimately have advantages and disadvantages. You know, butterfly and iron condors, they're great if you're expecting a drop in volatility. Butterflies can also be great for directional strategies as well, if you're looking to risk a little bit and looking for a little more speculative. But I would say ultimately my most favorite strategy is probably, and you might know it, is the diagonal. So I think the diagonal is probably the most flexible strategy, and here is why. So let's say we go ahead and build a diagonal on Amazon, and our diagonal is 36 days out, and then we'll go ahead and buy the protection on the December, which is about 71 days out, and I'll go into the 1740s on the calls. So here, when you look at this, you can see, okay, it looks like a calendar for now. And yes, that is true because I have the same exact strike price right there. But here's the power behind diagonals. Number one, why I really like them and why they're powerful is if you're using these in retirement, long-term portfolio strategy, you have a positive vega. What does that really mean? Well, it means when stock prices go down, you actually get a little bit of a benefit and cushions because it makes your tent a little bit wider. So it actually helps you if the stock price goes down. It cushions you a little bit. It's not going to help you a ton because you still have positive delta over here, but it does help you in the sense of, hey, if things do go down, that tent does cushion you slightly. The other reason I really like this strategy is because you can rotate it. So say, for example, I look at my 1740s over here. What I could do is say, I want a little bit more bullish or bearish. I could go 1735. I could go 1730. And look at what that does. It starts to rotate my curve slightly. I could keep rotating, and it's micro movements. It's not like a big movement like you have with some of the other strategies. It is small and subtle movements. Now, where you don't have a lot of strike prices, let's say there's not a ton of strikes, you don't get those kind of minor movements. You know, the movements are a little bit bigger relative to the percentage-wise. But in this case, you could see, hey, it moves quite minusculely. And let's say I want to shift it a little bit left and right relative to the price. Well, I could do that as well. So say I want to, you know, bring this back to the 1730 and bring this to the 1690, bring this to the 1720, bring this to the 1680, bring this to the 1710. You can see I'm just shifting my graph, and now I could go ahead and rotate it. Whoops, that one's not traded. Rotate it again a little bit at a time. So you could see right there how flexible it is. And once you start stacking two of these, let's say one on top of the other, so let's say I go ahead and do 1710 for everything, and I go ahead and analyze another trade, and now I'll go into the 1730s. Okay, so you could see, okay, well here I go ahead and I have one and I add another one. Well, now I could go ahead and rotate this one. So now between those contracts, I got a really flexible strategy, and I could go ahead and bring this out to the 1750s, and you can see I'm jumping quite a lot, but the movement is minor, and that's the power behind it. That's the flexibility behind it. and it allows you to have the positive vega, in which case if, let's just bring out our group here, and let's say the volatility goes up. I'm going to change that to about 5 points. Volatility goes up 5 points. Well, look, I'm up $800. Not that it would jump 5 points that quickly. Let's say even if it goes up 1 point, stocks sell off. Well, it cushions me. Even though I might be losing on the delta, as it pulls back a little bit more, while maybe volatility increases a little bit more. So again, it cushions me more and more as those things continue to kind of pull back and sell off. So that's really what I like about this strategy. It's very powerful and it's very, very flexible. And you can do it short term, you can do it longer term duration. There's a lot of flexibility and tweaking you could do at a minor scale. Whereas with other positions, if you do one shift in the strike price, you have a huge, huge movement and a huge, huge change. Anyways, I hope you found this video helpful and insightful. And if you have a specific question you want me to answer, go to our website and submit a question by voice, and that way you can get featured on the show. You can also join the newsletter list there. Or if you just want to hang out on YouTube, no problem. Just hit the face icon here, and that way you'll get notified as we release new training videos. Thanks again. Remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next video.